Hello and welcome to the Financial Markets Insights in Conversation with podcast. I'm Tina Kane, and today I'll be talking to Hirander Misra, founder and CEO of ZERO13, an AI and blockchain powered hub that connects international carbon exchanges, registries, custodians, and ESG project owners. Hirander is also the founder and CEO of GMEX Group, which creates sustainable technology solutions that bridge the gap between traditional and decentralized finance. Welcome, Hirander. Let's start by asking you to give us a bit of background about ZERO13.
Yep, it's a pleasure to be here, Tina. I'm the chairman and CEO of ZERO13, and that's part of a larger group that's been in existence for about 13 years called GMEX Group as well. ZERO13 has really originated out of the GMEX Group because GMEX Group was set up as a market infrastructure company, but more for financial markets. But a few years ago, based on the work we'd done to kind of bridge between traditional and digital assets with our infrastructure, everything from enabling exchanges and the interconnected infrastructure, connecting those and custodians in the wider market, we started getting approaches to set up carbon exchanges. Not knowing much about carbon, about 24 months ago, I started to look into it. And I realized actually the exchange was a little bit like the cart before the horse, because it was an upstream to downstream source to sale provenance issue. And yet, everyone was trying to look at this the same way that you would look at an equities exchange or a derivatives exchange. Yet the construct is much more distributed and decentralized. So realizing the whole thing was disjointed, at the same time, despite us having kind of modern day technology, we speak about AI and blockchain, but just, electronic trading technology and settlement technology, that none of this really existed in a proper fashion in a joined up way within the carbon markets. So that motivated us to set up ZERO13 because we really wanted an initiative as an entity that focused on those aspects.
And just for the benefit of our listeners, the 13 references, the zero I can see is a net zero illusion. Why 13?
Yeah, lucky for some, unlucky for others, but very much lucky for us because 13 is actually the UN Sustainable Development Goal for climate change. So for us, that was a key number because it was a key aspect of what we did. So zeros in net zero, as you rightly said, and 13 joined up, and then the domain name's 013.net. So that was the idea. I mean, it's always interesting because someone always asks us what's in the name, but it's a bit like, what I did before as well, because when I co-founded Chi-X all those years ago, everyone used to say, is it Chi-X? Is it Chi-X? So the name actually is a very nice icebreaker.
Since the zeros come up and the net zeros come up, it's obviously very timely because I believe you were recently at COP29, which is the convention or the bringing together of countries and nations around the whole subject of carbon reduction. There was a bit of controversy in the press about who wasn't there and people leaving, but generally speaking, I mean, how was the event for you? Did you think it was overall a successful event?
Yeah, I mean, it was my second COP, given that I was also at COP28 in UAE, where we were fortunate actually because 013 won the tech sprint as the best solution to scale climate finance for blockchain. And that was great because that very much put us on the map. And that gave us good momentum in the year that preceded heading to COP29 in Baku. Now, there are detractors of conferences like that, but the key thing is it brings over 50,000 people from across the globe together, notwithstanding we should all offset our carbon footprint from there. But, it's very difficult to get people from across the carbon or climate value chain, everything from finance to politicians to activists, all together in one environment. And for that very reason, you can deem that sort of conference very, very successful because, yes, it encourages debate. Are there controversial topics? Absolutely. But then, you can agree to disagree on some points. But the key thing that came out of this COP, which is very, very relevant and which was very exciting was one, after nearly a decade, Article 6 was agreed, Article 6 of the Paris Agreement. Why that's relevant is because that relates primarily to carbon markets and carbon markets development. So Article 6.2, even though it's wider with CORSIA credits, which relate to the airlines and what they need, more broadly, it's government to government agreements that lead to a certain level of high standards and high integrity around credits so that entities supplying in supply countries like Ghana can then match off with buyers in demand countries like Singapore and get the right price. So 6.2 was great because that really will drive forward a type of carbon credit called internationally transferred mitigation outcomes, or IPMOs. 6.4 as part of that was also agreed. And 6.4 talks about a common mechanism, common framework, governance standards, if you may, around carbon markets, because, lots been made of market standards and processes being fragmented. But Article 6.4 really looks to standardize and operationalize common mechanism for this. And so that's really, really interesting. I mean, by no means does it mean, okay, we're going to move to a single carbon market, because the carbon market by its very nature is decentralized. The finance could be in Singapore. The project could be in Kenya or Ghana. The carbon credits that result from that could be in demand in Middle Eastern countries because of oil production. So you've got to have a construct that's both local, regional, and international as well for it to truly work. The other aspect, which again, there's a lot of controversy about, was 300 billion of available financing from developed countries, 23 different ones, if you include the EU as a single entity, to developing nations in the global south. Many talk about 300 billion by 2035 not being adequate. I would say, actually, the pledges have to materialize. And most pledges that were made in COP28 didn't necessarily materialize into real money. And what we say, when we engage in those developed countries, is there's no such thing as charity. Again, being fished for isn't as good as being taught how to fish, so to speak, unless you're a vegetarian, of course. But, again, it's really, really important that these projects are made economic. There's tangible community development and an increase in incomes, which then also results in an increase in national GDP. And if those projects are economically viable, the money will flow in, whether it's equity or debt as well.
I think that's an important point, isn't it? Going slightly off tangent, you've talked about that. You talked about the whole carbon markets generally, and there has been potentially a bit like COP29 itself, a perception that sometimes it's a bit of a box ticking exercise, and there've been, you're still burning the emissions or making the emissions, you're just offsetting them in some way, and it hasn't been necessary. Some of them haven't been very high integrity and high quality. And it seems that there is more and a very welcome focus on actually looking at high integrity projects and having, I think you said, source to sale, having that provenance that you can see all the way through all the state, throughout the entire process, that everybody's benefiting, that you can actually be doing something good in terms of carbon credit or project investment and still have an efficient or a good return on your investment. They are good investment opportunities, provided you do have that transparency all the way through. So I know you're particularly keen on addressing the disparities, for example, between the investment from the global north into the global south. But I think it would also be fair to say the carbon credit activity or the carbon market activity, moving that, getting people's attention more focused on the opportunities in the global south. And that clearly was one of the bigger outcomes from COP29. Can you tell us a bit more about that from your specific perspective?
The good thing here is, I mean, we engage with a number of countries in the global south. We were at COP29, we made the announcement where we're enabling digital infrastructure connecting the Ghana Carbon Registry, which is their national registry for Article 6.2 trading into Singapore, for example. Now, the key challenge in voluntary markets has been the fact that there's no real pricing mechanism, which also then means, when project developers are putting together projects in the global south, it doesn't matter whether it's land use restoration and specifically agroforestry. It doesn't matter whether it's cook stove projects or something else, again, renewable energy or specifically solar with additionality. The biggest problem has been you're kind of doing it on a hope and a prayer, because you don't quite know what price you're going to fetch for those carbon credits, whether they're carbon credits that are fully verified and delivered on a spot basis, or whether they're forward credits. And even if they are forwards, then you're not quite sure how much they'll be discounted, working backwards from the price because there is no forward curve. So that in itself means it's very difficult to try and determine whether your project's going to be economic or uneconomic. If you can't determine that, it's very difficult to get finance on those projects, because typically, even on power projects, on renewables, where power purchase agreements for offtake are great because, the banks and others will finance that, the carbon credits are often discounted down to zero. Yet, you and I would agree that those credits have value, yet they're not taken into account, under normal levels of financing. So now with something like Article 6.2, when those credits are aligned with the carbon tax of certain countries. So, for example, currently in Singapore, that carbon tax is 25 Singapore dollars. All of a sudden, you can work backwards from that and you can determine that, yes, irrespective of fees or irrespective of bid offer spreads, I'm going to get a certain price for my credits. That allows me to now look at whether my project's viable. But at the same time, it gives a lot of confidence to buyers who also know where the price is, or financiers, because they can take into account those carbon credits, whatever way you package it, as a concession or not, into their lending decisions or into their forward buying decisions. So this unlocks, or will unlock, a great deal of capital. Again, the standards around 6.4 mean there'll be a distinction between low integrity credits and high integrity. And high quality doesn't always mean high integrity. So it'll encourage a flight to quality. That's actually a good thing, because even companies have unintended consequences. Many, as part of a wider decarbonization strategy, are looking at carbon offset programs. That's great because that would create demand from those global south countries. Yet all of a sudden they pick the wrong credits to buy an offset, and they're the next Guardian article. So I think, again, standards like this and governance mechanisms can help address that. I think we'll see a lot more money now on the back of, Article 6 being agreed, flow into those global south countries. We're aware of some excellent projects, whether it's agroforestry or other sectors like cook stoves in the likes of Ghana, Kenya, Uganda, and other countries. And there'll be a level of consistency around price in these countries because they're geographically on the same continent, even though some will be in East Africa, others in West Africa. Whereas at the moment, even government-driven sovereign credits are struggling to be sold in the market.
Is there an element of that, a bit like, I mean, I'm old enough to remember the advent of technology in financial and capital markets. Is there a resistance in the sort of the traditional capital markets just because they just don't understand them well enough? They just don't really get it because, as you said, it looks a bit like an equity exchange, but are they more like commodities, and it's a sort of supply chain angle, and it's not. Do we need more education to get people to grasp actually this, to your point, the source to sale, what this looks like, how this merry-go-round of investment works, so that you get more comfort if you're a traditional capital markets player, that you can get a return, you can manage it, it is transparent, it is auditable, and something we haven't touched on, but you might want to, and how you reflect it on balance sheets so that it looks more like a traditional investment.
Yeah, it's an excellent question, Tina, because there is a translation issue here, where everyone is talking a different language. And let me illustrate this. So those that are on the supply and project side, and rightly so, have very little understanding of the way capital markets work. And those that are buying credits for offset, whether it's a tier one, tier two emitters, or anyone else for that matter, again, have limited interest as in limited knowledge, and also interest to learn about capital markets, because a lot of the time when they've needed those instruments, whether it's for hedging or otherwise, then they've typically gone to their sell side banks as corporates, and the sell side banks have happily serviced them. And that's worked reasonably well, no matter what someone argues about whether the price of that servicing is right or wrong. It's been functioning for many, many years. At the same time, the banks in the middle don't necessarily understand the supply chain and the upstream technicalities of this. I've had tier one banks recently where, carbon desks sit under the commodities desks, talk to me about the fact that we actually don't know what we're trading. And recently, some banks have announced that, even before starting, HSBC, for example, recently, that they won't necessarily be going into carbon trading and financing for some of the inherent problems that we're discussing here today. And that's not for want of there not being opportunities. I think there's a fantastic opportunity for capital markets, no matter what the debate is, whether it's a commodity or a security. And I could argue through structures, it can be both. You had exchange traded commodities be very successfully channeled into exchange traded products as well as derivatives. So, you've got a securities and derivatives play as well. So I think you're absolutely right, Tina. I mean, there is a discord between them. It reminds me of when I started my career, actually. When I go back 28 years and I joined Reuters, which is now Refinitiv, the technology guys didn't know about the business and capital markets. And those guys on the business side had no understanding of technology. They saw these screens. I got very, very interested at that point of time because the two sides just didn't talk to each other. I mean, it was a bit like the business guys going, "Oh, can't you just turn on a switch tomorrow for a development release?" So I decided that actually I wanted to learn about the technology side, did a master's, and then never looked back because you became that bridge between both sides. Again, a little bit of deja vu many years on, that's where I think the inherent knowledge of the team that we have and other partners, because it's not just about us, it's about being collaborative, will allow us to bridge that gap and allow that translation. And I think that's very, very exciting because if we can do that, it can channel that river of liquidity from the capital markets into the climate side, which is going to be game changing.
Yeah, I think you and I probably had the same experience. I was the enemy of Refinitiv. I was at EBS, but it was that time where we've always done it this way. Voice traders, for example, we've always done it this way. Suddenly it was like, oh no, hang on. A, we are going to change, and B, that you don't need to understand the technology, but you had to understand that the technology was the way the solution was going to be executed. You were still doing the same things, but you were doing it in a different way. So for me, this is like you, it's the next exciting thing post big bang in financial markets, because the reality is this is not going to go away, right? We can't ignore the gigantic climate elephant in the room. So back to that, actually, in similar vein, there's, as we know with any financial markets, there's always a regulatory angle, there's always a transparency angle, an integrity angle, an interoperability angle. I mean, would it be fair to say that exactly the same applies to what you're doing? You need all of these component parts all to be working better and to be developed to the extent that they're all working at the same time rather than doing things in sequence. All of these things have to come together, right?
Yeah, it's very, very interesting. And again, there's a lot of parallels from earlier on in my career here because, when we shook up equity markets with Chi-X, we were dealing with effective national monopolies, the stock exchanges. And yet, when we tried to get into clearinghouses or tried to get into depositories, the door was firmly shut. So we had to find an alternative way, and that affected change. I mean, it took 3 years to establish clearinghouse interoperability, but we did it. Coming up against the same things again, as we engage in the market, there are incumbents. The market hasn't really been used to technology. WhatsApp messaging and spreadsheets are common. And there's even more so manual processes as well, sort of going back to, my time on the brokerage desk in the late 1990s where, it's almost swivel chair, no APIs, from one system to another and manual input. Now, I mean, that's really interesting because, you've had carbon markets that have been around 30 years or so. And there's a lot of inherent knowledge, that resides within people that have been in those markets from that time. Many of those were at COP as well. But I think what's happening now is a sea of change because a few years ago, everyone was reluctant to change and said, oh, this is the way it's always been done. But then obviously you had a downturn in terms of trade sizes and market volumes as well, when you look at 2023. And then there was a little bit of a reality check because people began to realize, or certain people, because there's always going to be the incumbents, but there will also be innovators, whether it's large multilateral development organizations or commercial organizations. Certain individuals in those organizations, as well as more commercially, began to realize that there needed to be some level of change. That's timed well with us coming into the market. I can say, was it planned? Sometimes you need a little bit of luck and timing is everything, but there is an appetite for change. We saw that again. A lot of work's been done on Article 6, but why has it been agreed now? It's because the markets realized it has to come together and collaborate. We're still seeing as we make those requests to connect to certain registries or connect to certain established players, we're still seeing a level of incumbency in some walled gardens there, not to be too controversial, but I always can't help it. Now, at the same time, we're using that as a mechanism with those that want to change to affect change, and the others are starting to realize there's real benefits in that. So, for example, some of those international registries are quite open and welcoming. Others create a wall of bureaucracy around them because they don't really want to let you into the old boys club, so to speak. Even old boys clubs have now, opened their doors to all. But if we can demonstrate, which we've done, that you can connect to newer digital registries, some of the international registries, but also some of the government-driven national registries as well, and you can integrate in digital processes like measurement, reporting, and verification that's more automated, that affects change. We've seen that on mini grid solar with some of the work we've done out of South Africa with partners, and that's led to a 3 times price premium on carbon credits compared to normal solar credits. Again, notwithstanding the debates around additionality. So I think, if we just sit there and complain, nothing will happen. You've got to swing the bat to hit the six or make the home run. And if you're listening in America here, and that will affect change in the broader market. And we're beginning to see that change beginning to emerge, and that's incredibly exciting.
I think we've touched on this before. I suspect there's that element of initially, yeah, we don't need to do anything. We're just not going to do anything because it's going to go away. And then they're like, oh, it's absolutely not going to go away. But we'll let somebody else go first, and then we'll see how well it worked for them. And then I think I agree with you. We have to do something. We've got these time imperatives. We've got these dates, and we've been a bit slow starting. But in reality, let's now look at what we need to do. And I liked your point. You've made it before. Interoperability doesn't mean everything has to look the same. You don't have to worry. If you run your registry this way or your registry happens to be digital technology backed or not, doesn't matter. It's about how these things can all talk to each other in order to make something more fungible and something more, so it's not exclusive. It immediately becomes more inclusive, right? So that's a good thing. You touched briefly on it, but there's also that, oh, it's the other thing, blockchain and AI. But all of these things, again, together, they're not exclusive, they're inclusive. Not, blockchain has its merits in terms of immutable facts and provenance. AI, as you said, data. Data is interesting, isn't it? Because I think, again, with the carbon markets, you can use, satellite data and all this technology now to actually prove that these things are real, to prove that, that the environment is being protected, or there is less deforestation. You can actually look at projects using this technology and see that they are real. They're not just someone claiming to offset or reduce or store.
Yeah, I mean, and that's a key thing now because, technology at our fingertips can really act as the enabler. But, there are lots of different blockchains. It's not one ubiquitous technology, but actually allowing interoperability between those, but also more centralized systems that have APIs is important. But upstream, IoT, we've seen that on industrial carbon initiatives. You have much more automated data collection, and we're able to baseline a lot easier for digital measurement and reporting. That also allows you to then verify a lot more easily, a lot more quickly, a lot more cheaply as well. Which also then, because as you said, it's an intangible commodity. How do you know one carbon credit is a piece of air effectively is valuable and the other one is junk? Now all of a sudden in a smart contract, you can see the whole life cycle. And so, even with carbon credits, we didn't really have that kind of end provenance, much like we've lost that link to the food, from farm to fork on our plates as well. But, you can really prove it. We have, other organizations have as well. And irrespective of insurance wraps or ratings, all of a sudden, because even the insurers, to give you a better price on insurance, things like this really, really help because you're de-risking as far as they're concerned. Now, interoperability is an interesting one because you and I are used to it. In this modern era, you might be on one phone network, I might be on another, or we might be communicating on WhatsApp and we don't quite know how, what internet connections, but we can still talk to each other. Yet we're in different places on different devices using different means. So I think the technology exists. Sometimes a lot of these kind of walled gardens are driven by self-interest as well. And I think competition was a phrase I coined, when we were doing Chi-X some years ago. I don't keep wanting to be harking on about that, but there's a lot of analogies. But the industry came together on key issues, even though we were competing, and that included both the primary exchanges and also the newer ones as well. So at the same time here, we're beginning to see real industry collaboration. For example, as part of ZERO13 and that kind of network of networks, and we have over 70 partners within the network, and they all have different roles. Some have competing services, but actually, that also helps because it creates efficiency in the market. Competition is a good thing. Monopolies aren't necessarily a good thing. So in that sense, I think we're beginning to see interoperability. We say, okay, we've got a network, but our network should be connecting to things like the Climate Action Data Trust, which is an initiative by the World Bank, IATA, and Singapore government, which allows for transparency of registry activities to avoid double counting. At the same time, you should be connecting into multiple digital MRV mechanisms because that avoids greenwashing as well. So I think we're going to see a real joining up of these things. And that's something we're big advocates of and very much part of our ethos and business plan at ZERO13.
I think that actually 013 is proof positive of exactly this inclusivity. You're not saying we'll do it my way or we're going to take all this out. Ours is better. You're actually saying let's all just come together. will facilitate this with technology, the ability for it all to you all to carry on doing your thing, but to actually do it in a way that's for the collective benefit, in this case of the climate, but via these projects and so on. It's obviously a fascinating subject. I was going to say, in terms of, actually, I had one other point in terms of corporate activity. So, corporates, obviously, are the ones who are under the industries are under the biggest pressure to demonstrate that they're reducing and or offsetting emissions. And other people have raised this before that maybe there should be a different approach of incentivizing corporates to change, to actually take action to both reduce their own emissions rather than just say, look, I've bought 10 million credits, so I'm good. Do you think there is more scope for that, to have a different sort of incentive or tax benefit scheme whereby big business, industrial players, their efforts can be rewarded much more tangibly, through tax breaks or what have you, which would also help them achieve or commit much more actively towards carbon emission reduction?
Yeah, it's a very interesting question, and really we're seeing a variance on this. As we engage both with developed countries and developing countries, some developed countries like Singapore are forging ahead from a policy perspective. Their accounting rules are changing next year as well. So that there'll be a level of disclosure around green, grey, and black assets on balance sheet. Much like you have Sharia, non-Sharia assets in the Middle East as well, and that's really, really interesting. But notwithstanding, we must all realize there's a massive cost of compliance for a lot of corporates. So yeah, incentives are great, but equally incentives cost the exchequer in revenue, tax revenues, and equally, I know developing countries are also introducing carbon taxes. Kenya's legislation garners, because that also brings in much needed income, assuming those credits are then sold and monetized. And there's different ways to do it. So if you look at corporates, when we go in, we say, okay, great. Everyone's talking about compliance, and that doesn't mean compliance credits, but generally, ESG compliance and carbon offset strategies being part of a wider decarbonization strategy, which they should be, albeit for the likes of SMEs. When countries introduce regulations, they don't really have necessarily out and out decarbonization strategies. They might have solar or, replacement of, to renewable energy sources. But at the same time, carbon offsetting is going to be a key part of what they do. Now, when we go in, we kind of say, well, actually, this can be a revenue opportunity, which then channels more funding into those projects that needs it. Now, how can that happen? I mean, on the one hand, a lot of brands, if you look at Gen Z and others, my daughter's 17, but she's very, very passionate about the climate, and she gets very angry. I mean, in fact, she's passionate. And, with that, we were discussing AI, and she was giving me numbers on what the overhead is, in terms of carbon emissions from AI technology as well. And she asked me how we address that, because, unintended consequences, it does cause a footprint. The same argument's been had for cloud providers as well.
And solar farms and all of these things, right?
Yeah, exactly that. So what's really, really interesting is, when we engage with corporates, and there's an increasing level of engagement, and we started with the tier twos and some of the emitters as well, we say, actually, that's great. You can buy high integrity credits. There's a wider green industrialization strategy that you're undertaking, but also you can now align your brand to do the right thing. And where you're consumer facing, how do you involve your consumers? I mean, we did a pilot with Zilliqa, the blockchain provider, at COP28, where we showed that instead of earning loyalty points, brands could now provide consumers, based on their purchases, credits that could then be allocated against carbon projects.
Yeah.
So all of a sudden, those users now have their purchasing behavior that could have a carbon footprint now translate into income that goes to global South countries. But at the same time, the brand gets brand value, because all of a sudden it's doing the right thing. Equally, we're speaking to some countries, I think, one GCC country in particular, which I can't name, and they're saying, actually, why shouldn't consumers, based on better behavior, if, Tina, you install solar in your home, or you look at practices that are more sustainable, why shouldn't you have the ability to have your own digital wallet and have the opportunity to have that measured for you and earn credits into your wallet as well? So I think brands can really get closer to the consumers and the younger generation as well, which are a growing market, especially if you look at developing economies. And I think there's a real opportunity here, even on the financial services side, to create new products, whether it's structured products, whether it's green bond instruments that translate into other instruments, digital assets as well, to generate revenue from this and then channel that revenue upstream. So it can be a win-win situation, actually.
Oh, great. I'm thinking of some Tesco club card points, but actually having those in a climate beneficial form. And I think you're right. I think younger generations are much more savvy than we are, much more aware of the need to do something. And it is going to be increasing a competitive edge, isn't it? No, I want to buy my produce from you, or I want to invest in you because you are demonstrating that. We could talk all day. This is absolutely fascinating. I was going to ask you, what do you see happening in the next 5, 10 years? Where do you think we're going to see the biggest change or the biggest embracing of this change?
Yeah, it's an excellent question. I mean, if we look at the next few years, we're increasingly going to see a convergence of technology, finance, and sustainability because everyone talks about, climate finance, but climate and finance aren't necessarily joined up in the way that you and I understand in other asset classes and can scale. So, you're going to see a convergence of those elements. And when we say convergence of sustainability as well, standards, governance, data as a construct in all of this become key elements. But with that, really, I mean, recently at COP29, we hosted an event at the Africa Pavilion, which was sponsored by African Development Bank, African Union, and others. And there was a senior representative from the Commonwealth, also one from the United Nations Development Program, Ghana, Kenya, and Seychelles on there. Just coincidentally, it turned out they were all working together on various projects, and one thing had led to the other. Data was one aspect, registry standards were another. So that was really good. But what came out of that was actually the model needed to be kind of less focused on donor funding, which doesn't necessarily scale. Of course, that plays a part to some degree, but it had to be focused on commercial endeavor. But how could we do that doing the things that we were already doing? So, for example, rather than reinvent the wheel and duplicate, the Commonwealth did what it does best, and it's kind of having input into a blue carbon framework, for example, in the Seychelles, and blue carbon could be fundamentally game changing for their economy on seagrass and mangroves. At the same time, the UN could help with registry infrastructure. We could come in because we could help enable that and scale it and operationalize it. And at the same time, the UN had come up with that construct because they'd taken that from what Ghana had developed with their registry and the construct there. And they developed the data standards around that with the Kenyans that were then deployed in Seychelles. So we can create real circularity, and we are doing that even without knowing it. So, for example, when we announced our engagement with the Ghanaian government and the Environmental Protection Agency, it just turned out that one of the organizations that's already a partner of ours, even without us realizing, was doing sovereign bond issuance projects within Ghana. And all of a sudden, the two come together around all the work that Ghana's done, we've done on infrastructure and what they're doing, and it can really scale. And, a recent event, as you're aware, Tina, the same thing came up in Uganda, and it comes up in Kenya and other countries as well, outside of Africa. So I think we're genuinely going to see that convergence. We're genuinely going to see much more collaboration and technology being the enabler for that. And I genuinely think you're going to see scale in terms of finance and new financing models emerge, of which the capital markets are going to play a key part. I was very, very excited by the fact recently where, lots been made recently of the London Stock Exchange losing listings or, not being the market that it used to be for capital raising, and maybe that's the US. But again, at a recent conference in conjunction with the Indian government and one of their arms at the London Stock Exchange, the London Stock Exchange outlined how they're developing, even though they don't necessarily have the expertise to buy and sell and create a marketplace for carbon credits, what they're doing is listing project SPVs after due diligence. Those SPVs generate credits that have a value and are reflected in the value of that SPV. And in turn, that allows investors in capital markets to come in and invest. Similarly, we've launched structured products with partners that allow this to be a security as an asset on balance sheet. All of a sudden, that can be financed, collateralized, that can reflect on balance sheet as a real asset, whereas in many cases, carbon credits aren't. So we're going to see a real convergence of examples like that on the finance side as well. So I'm terribly excited. Now, 10 years on, with the way markets are moving, and we've seen rapid movement in the last few years, sometimes it's really difficult to call. But I think, again, it's not going to take 10 years to now see iterative developments in Article 6 or offshoots from that. You're going to see an iterative process. So it's going to be very much a process, not an event.
You'll feel, I think, that we should end here. It's been fascinating. There's going to be a ramp up now. It's been a bit of a slow burn, but now, as you pointed out, it seems to be that both the secularity and the increase. Everyone is now, there's more of a sense of, oh, okay, we've all got it. There is no one answer. We're not waiting for this holy grail that's going to solve all the problems. We just need to crack on and work with people, and we can do the bit that we're involved in, but we need to be collaborating with other elements who can help
I mean, there'll very much be an exponential growth curve here. And we're not just saying that because we're in the market. Of course, we're here and we can see things developing, but sometimes there's always sunk cost fallacy as well. But the hard work has been done to lay the foundations. Yes, it's taken 10 years for Article 6. Yes, is the finance as much as what's needed? No, there's a multi-trillion-dollar annual financing gap. And so with that, proportion of that with 300 billion by 2035, is it adequate? No, it's not. But actually, that can be the catalyst on the back of those pledges materializing that'll bring more capital in. And we're certainly seeing that from alternative sources, whether it's centers like the Middle East as well, that are now increasingly looking at this space and aligning what they're doing, both in some parts of ASEAN and Africa, towards energy and food security. That's of paramount importance, whether it's Saudi Arabia, whether it's the UAE, whether it's Qatar as well. So what we're going to see is some drive where, first movers become now second movers, because we've had the first movers already, and those second movers have learned from lessons of the past, but they're also applying new models, and we're already seeing it. Those that are just sat there moaning and saying it's all too difficult, they can continue to do that, but the market's already shifting around them. And I think we're heading into a good place now where, yes, the growth will be exponential. Will there be challenges along the way? Absolutely. But those challenges are good problems to solve.
And while they're being solved in the meantime, hopefully we're moving towards at least the much more likelihood that the projects and the investments are actually achieving good things, both environmentally and local communities and for the benefit of the climate. So all is good. That's very exciting. Thank you very, very much for your time. Is there anything we've missed, do you think?
No, it's been a pleasure. And what I did say at the African Pavilion was the fact that, again, not just for Africa, but it's very relevant across African countries. There's 55 countries in the African Union, and more broadly, there's been a lot of focus on the Commonwealth, across the island nations, which are most at threat with climate change. And there's 56 countries as part of the Commonwealth. Again, this could be the largest export commodity for these countries if we get it right. That's fundamentally game changing because, we've worked out with our analysis, a country like Seychelles, which has a GDP of around $2 billion a year, that GDP could go up 25 to 33% over the next few years if they get it right. Now, that also brings its own challenges as well, because again, with that level of growth, you've got to manage that, you've got to govern it correctly, it's got to be channeled in the right way. But there can be a fundamental difference. If incomes go up, children's nutrition goes up, there's more women's empowerment, there's better lifestyle and economic development. So we're really passionate about this. We've been in Africa and the wider GMX group since 2014, but now we're beginning to see the signs where there's real potential here. And we've got to kind of learn lessons from how other assets have been handled in these countries. And if we handle this correctly, and the developed world has a big part to play, it can be fundamentally game changing. But also it could be, even on one level, the breadbasket for us as well, into Europe. We've all seen post-COVID inflation go up, everywhere. And there needs to be other channels of growth. So there's a micro element here, but there's a real macro positive impact if we get this right, which we will.
Thank you so much, Aranda, for your time. As always, it's been fascinating, and we'll almost certainly be coming back to talk to you again. In the meantime, thank you very much, and good luck with 013 and everything you're doing.
Thank you for having me. And it's been an absolute pleasure. I really enjoyed it.